Good morning, everyone, and welcome to the briefing on the Chief Economist's Outlook 2025 and our discussion on where the global economy is headed this year and what leaders and policymakers can expect from the next 12 months. The Chief Economist's Outlook has been published a couple of days ago here in Davos, and it's the result of a survey of around 50 economists, both from public and private institutions, and 3 of them are sitting here with me on stage today. We have Fernando Honorato Barbosa, Chief Economist of the Banco Bradesco from Brazil. We have Karen Harris. She is Managing Director of the Macro Trends Group from Bain & Company. Welcome. And we have Gilles Moëc, Chief Economist of AXA Investment from the UK. Welcome. So before we start our discussion here on stage, a very quick remark to our online audience. If you want to share ideas we discuss here on stage or numbers from the report, please do that, but use the handle and the hashtag WEF25. Now, to get the discussion going, let's briefly look at the most important findings from the report. The outlook for the global economy in 2025 remains weak, with many downside risks. I think that's not a big surprise. 56% of the chief economists expect conditions to even weaken over the next year. Only 17% foresee an improvement, so very little space for optimism. And main reason for this outlook is the increasing uncertainty all over the world. The IMF has delivered the numbers. A couple of days ago, the global economy will expand by 3.2% this year. That's basically unchanged from 2024. And that will slow to 3.1% over the next 5 years. But we also see a very significant divergence, regional divergence. This is what we are going to discuss here in a minute. A very good outlook for the United States. 44% of the economists predict strong growth for 2025. Compared to only 15% in the last survey, so that's a big jump. South Asia is also expected to maintain strong growth, and here are all eyes on India. For many other regions, the economists are less optimistic, and this is what you can hear in Davos in many discussions already. Europe ranks as one of the weakest regions. 74% even of the economists expect weak or very weak growth for Europe. And this would be the 3rd slow year in a row. In Germany, we would say Europe has the rote Laterne, which is carrying the red lantern. Also weak, the outlook for China, and growth is projected to even slow down in China for the next couple of years. Quick look to inflation. Global inflation is easing. IMF projects an annual average of 4.3% in 25. Down from 5.8% in 24. However, services inflation remain higher than good inflations, especially a topic we are going to talk about in a second. So these are the main facts. Now let's turn to our esteemed panel here today. So what are your expectations? Maybe let's start with you, Fernando.
Okay, no, fantastic. So thank you very much. Thank you for the audience. Let's say, I think the key driver of this type of not say pessimism or some extent realism, is about fragmentation. We'll have a chance to talk a lot about that in a minute, Sebastian, I know. But the thing is, we are talking about a world with higher import tariffs, we're talking about a world of high fragmentation, we're talking about a world of low efficiency. I always joke, globalization was not because of globalism, it was because of efficiency. So if you are going back a step in which we'll have less globalization, we'll have trade barriers, this means that companies will face higher costs and consumers will face higher prices. So as a result, it's very hard to see growth buoyant these years.
Karen, your outlook.
I think if we start with what Fernando is right about, that we've had this globalization, one underlying structural element of that that's really important is that it has created a dependency on the U.S. as the buyer. Right? If you look at net goods importers, the U.S. dominates that. Net goods exporters, China and Germany are the two. And this is what the Trump administration talks about when it talks about the trade imbalance. And that has deleterious effects on the workforces in the United States and the manufacture of goods. And that wrenching attempt at rebalancing is a lot of what we're seeing proposed by the Trump administration. Some policies may or may not work, but that is one of the critical objectives. So that, I think, is creating a lot of uncertainty about how that will unwind. I think the second piece, the more near-term piece, where I hate to be the grumpy economist, but where we're less optimistic about the US outlook, is that it depends on the affluent consumer. That 20% of the US affluent are about a little over half of US consumption, and their number one driver of consumption is equities and the performance of equities. They're very markets driven in their outlook, and the US stock market is larger than, in equities, is larger than the next 10 combined. And so we're talking about global growth and US growth that is very reliant on US affluent consumers, and that because of that market link and because of where valuations are, that creates a fragility that I think is concerning.
Gilles.
Good morning, everyone. Thanks a lot for having me. Well, we're in line with the findings of the survey. We're above consensus for the US in 25, with some deterioration in 26. I agree with you that things will get a bit more complicated, and below consensus for China and Europe. But I would like to reflect precisely on the fact that the survey is an average between those two very polar situations. And we should reflect on this because most of us were trained in the idea that it's the US which sets the tone of the global cycle. And in a way, what the survey tells us is that we no longer believe it's true. We believe that the US is going to do very, very well, but this is not having any significant traction effect on the other regions. So the big current account deficit country is no longer supporting the rest of the economy. And before we get to the T word and what Mr. Trump may have to do with this, a point which for me is absolutely central is that we should not forget that this divergence, this gap between the US and the other regions, is to some extent an extrapolation of what we've been seeing for many years now. The new US administration has no bearing in the fact that productivity in Europe has been stagnating for years. This is our own doing. The US administration has nothing to do in the fact that China is in the middle of a real estate correction. It has nothing to do with what was coming from DC. So we have these forces which have been shaping the world economy for a number of years. And 2025, obviously, we are tempted to ascribe a lot of what's going to happen in the month ahead to what's going on in DC, but we should also look at ourselves and our own responsibilities in the gap between the US and the rest of the world.
So let's come to the T word. Donald Trump and the US policy are playing a major role here in Davos on almost every panel. So it has to be discussed here as well. The chief economists expect US policy to have a significant impact on the global economy. I think no surprise. 61% believe this will be a long-term shift. I find that striking. What is your expectation, Karen? What will this long-term shift look like?
I think the election of the re-election of Donald Trump it puts us decisively on the road to what we call post-globalization. It's not deglobalization, because actually there's no necessary diminishment in global trade, but the direction is changing. And the best way I can describe it is that we are moving into a more Westphalian world, with the nation state taking preeminence over multinational and multilateral orders. So we see more bilateral agreements, we see trade, again, restructuring in different directions. We've been on a path, the world, by we, I don't mean the United States, I mean we, all of us, have been on a post-global path, I would say really since 2015 in a decisive way. It's not just Donald Trump, but Xi Jinping's change of policy that have changed that. But this is really, I think, the point at which that reality has set in. And I guess the only flag I would say is that we hear a lot of descriptions that this is a US-China rivalry, and I'm much less convinced about that. I do think it's a multipolar world, and we were discussing collectively van der Leyen's speech yesterday. Europe has the opportunity to create a common capital market and reinvest and be a pole, but my goodness, like let's get a move on that, right, to be that.
Gilles, 90% of the economists believe the actual tariffs will be smaller in the end than discussed in the election campaigns. How do you see that?
Possibly, depends on the day. The issue I have with the tariffs is that it appears as a sort of Swiss knife for the new US administration. It's not just about rolling back on China or extracting more defense spending from Europe. It's about anything. It's about fentanyl crossing the US border. It's about trying to extract from Europe more purchases of LNG from the US. So it is so pervasive to the entirety of the economic platform of the new US administration that my baseline is that some of it is going to happen. You know, it is there in so many aspects of the entire economic strategy developed by Mr. Trump that honestly some of it will come out. The question for me is, as a European, I'm obviously very, very selfish with that, is how much of this is going to be tailored? How much of this is going to be a sort of generic, uniform tariff on everyone? Because if it's a uniform tariff on everyone, it's kind of okay, because it would mean that the relative competitiveness of, say, European exporters relative to third parties exporters onto the US market would not change. We would simply compete differently with US producers, but very often there is no US producer for what we do.
Mm-hmm. I would just add that I think of tariffs as a tax on access to the US consumer. Effective or ineffective, that is the purpose of them. And so then it depends on who you want to tax and for what.
So that would be my question. So how does that all fit together? So the US is seeing strong growth. We will see lower taxes, but we will see higher tariffs. So what will happen with inflation?
We were talking about that right before, right, Sebastian? So let me talk about two possible inconsistencies of the outlook. So one is exactly what you just touched upon. So we see higher tariffs, we see less efficiency, we see more fragmented world, maybe post-globalization. How can that feed into easier monetary and fiscal policies? Maybe fiscal policies will be eased, and that will prompt demand, and as a result, probably inflation will pick up. And how can monetary policy be so easy? I'm not talking maybe about Europe, but that's the case of US and Latin American countries. So this is one possible inconsistency that I see. The second one is about AI. I know this is not a panel about AI, but if companies, they realize we are living in a world of more fragmentation, a lot of less efficiency, they will invest more in AI. This will, to some extent, try to circumvent these restrictions and maybe cause some issues, frictions to the job market. And maybe this goes against the promises of the politicians that they will create more jobs with these tariffs. So I see some sort of inconsistencies in this typical outlook. Again, populism has its easy promises, but the economy has its own restrictions. So by the end of the day, I think we'll talk a lot about the risks of inconsistencies of these policies we are talking here in Davos.
But what do you see, Karen, Gilles, for inflation? What is your prediction?
Well, first, I think one of the more important conversations we should be having is around price level, not inflation. That is what the election in the US and the elections in Europe are talking about. Nobody cares that things are only 2.4 or 3% more expensive than they were. They care that for the first time, if we look at groceries, for example, volumes have gone down. People are buying less food. So we can talk about that we've conquered inflation, and that's important.
Good point.
But I do think we need to, and I think the word populism is important. The elite, Davos has been disintermediated in this election, right? We have failed to convince people, we have failed to implement rules in a way that resonate with the majority of voters in a way that feels relevant. And I think, and we can talk about all of these economic indicators, but I think it's really important that we reground in what the population is saying, which is their quality of life, their sense of future, their optimism had collapsed, and they want a disruptive alternative. So there's lots of inconsistencies in this. Tariffs are inflationary, depending on who you deport. Immigration is either, if you deport consumers, it's deflationary, producers, it's inflationary, and there are built-in inherent contradictions. But but I think to focus on those details is to miss that big shift.
Gilles, what is your take on that?
I believe unfortunately, resilient inflation in the US, quite simply because, again, before using the T word, the US economy is doing well. Donald Trump won because the majority of American people believe that the US economy is not doing well. Objectively, it is. So we are already in a situation where growth is probably above potential, in a situation where even if the December inflation print was a bit better, inflation remains actually quite resilient. And the risk is that you add to this underlying situation, which is already, I would say, propitious to some resilient inflation, you're going to probably add inflationary policies. So you can have sort of positive version of Trumponomics 2.0. The positive version is you do deregulation and you offer very, very cheap energy and you get lots of investment. For instance, in AI, we got the announcement yesterday. Investment goes up and the US continues to widen its productivity gap with the rest of the world. Great. But how quickly is it going to trickle down to what is actually the bedrock of Mr. Trump's electoral support? So the risk is that he still needs to provide some other stuff on which he has been campaigning, inflationary tariffs and probably an inflationary fiscal policy in total.
Can we quickly stay with this point for a minute, because you, Fernando, also brought it up. Productivity growth is really strong in the United States. Gilles, what can Europe learn from the United States right now?
I think the risk, I think, in Europe is to try to replicate stuff which may not have been that instrumental in the recent acceleration in productivity in the US. We have IRA envy in Europe right now. We look at the IRA, just no, we need to do that. It's just that we don't really have the money right now. But if you look at what is probably the source of the reacceleration of productivity in the US in the last 10 years, it's actual decentralized decisions by businesses 10 years ago to shift their investment towards R&D and towards software investment. This is what they did 10 years ago. It's probably benefiting now. So one of the things we should remember is that there's something to say about the regulatory burden. And this is what something Mrs. von der Leyen talked about in a speech on Tuesday morning. We don't have a lot of money right now. So replicating IRA, I don't think is within our means or even within our political means, but it's stuff which is relatively free is to go harder at offering a better regulatory environment for businesses in Europe.
We'll open up for a Q&A in a minute, so get ready. We will have a microphone so you can add comments or ask questions. We have to talk about fragmentation. We came to that topic already. Many chief economists see a trade war dynamic and an ongoing fragmentation of the economic landscape. 94% of them foresee further fragmentation of goods trade over the next 3 years. Only a smaller majority, 59%, expect the same for service trade. So how will continued fragmentation impact global supply chains, Karen, and what new models of supply chains will we see?
I think we're already seeing the term is resilient supply chains, which just means more expensive supply chains and more of them that companies are investing in. I did want to make one comment.
What trends do you see there?
Sorry, I just did want to say that the U.S. can't afford the IRA either, right? Like the fiscal incontinence has been a big driver of growth, but putting that to the side, we're willing to postpone that debt rather than have debt breaks and rules around it. But again, we're seeing a redirection of trade, but cross-border trade has been flat. It hasn't gone down, and we've seen transshipments rise, who have been the big beneficiaries of the first set of tariffs. It's been the Vietnams, the Mexicos of the world, where access to markets has been pushed out. Do we expect to see that continue? Well, that depends on how effective the Trump administration is in the policy objective of balanced trade, because in a world of balanced trade, Vietnam is number 3 on the list of largest offenders in terms of a current account deficit, and the degree to which that policy gets pushed might change the security of investing in other regions in order to access the U.S. market. So I think it's that is unclear. The least risky proposition is to get closer to North America, but that is too expensive, right? There just isn't the labor force and the cost base. So that's the tension that companies are wrestling with.
So Fernando, what trends do you see when it comes to resilience in supply chains?
Yeah, so again, it's the second change we are seeing since the pandemic. The pandemic was the big one. Learned a lot about that, about resilience, as Karen was mentioning. Now we have the second one about how to trade, how to deal with these new partners, how to trade under these new tariffs, and how to reorganize our companies. And again, I insist, we will probably see a lot of AI playing a role in defining these things. But there's one interesting aspect of the report that says that services trade are growing much faster than goods trade. Goods trade are doing fine, but services are doing much greater. And again, services prove to us that defining the boundaries is not that simple, because where are you buying cloud? Where are you buying all those data for your AI inputs? So again, we might be living in a world where politicians believe that putting these trade barriers, they mean a lot, and they are really a fact for goods and for labor. We do not have the chance to talk a lot about labor, but preventing labor migration is very, very damaging to the global economy. But anyway, so we are living in those old days where politicians believe in these boundaries, of physical boundaries. Well, services trade are here to tell, yeah, it's a little bit different this time. So I think there are interesting things in the next few years about services trade.
I do want to run up one flag, because if we do have, what is the knock-on effect of more balanced trade, which won't happen quickly, but it's also less capital accumulation, right? Export-led growth led to big pools of capital, and less global roaming capital means more expensive capital. It means scarcer capital. It's fragmentation in capital markets and higher rates. And I don't hear a lot of discussion about that, but financial services have benefited enormously from this trade imbalance, and that is a place that I think we just don't hear a lot of discussion about.
Maybe there's one quick here, Sebastian. So about red tape, we were having a discussion. Again, it's parallel to this tariff barrier. Maybe one positive, just to keep one, is that by cutting red tape in US, I saw von der Leyen speech again saying, well, we need to cut that in Europe, and Gilles was saying that right before. So maybe countries will compete to some extent to cut their red tape. And I think this might be a good positive for the global economy, because they will not, you mentioned the financial services, and we benefit a lot from that. So maybe cutting red tape could be a positive outcome of all these new policies.
So I have a very interesting number. Is 2024 survey of US CEOs showed that the proportion of companies with plans to shorten their supply chains had jumped to 81% from 63% in 22. Will reshoring be one of the major trends in the global economy 2025, Gilles?
For me, the biggest trend on this is more wait and see, unfortunately, because rather than the word fragmentation, I prefer the word clubification of the world economy. You know, we have a number of small clubs of countries which get along pretty well and can continue to do business and trade together. The problem is that the clubs we were thinking about, even just a few months ago, are not necessarily the clubs which we will have in 6 months from now. There was a club which for me was obvious, at least seen from Europe. It's North America. There seemed to be quite a nice free trade agreement. Apparently, no, it's more complicated than that. So the idea that you can try to circumvent US protectionism by investing heavily in Mexico and Canada, well, maybe, maybe not. Latin America in general, well, you could actually cut it in two. You've got a part of it which is increasingly driven towards China, a part of it which continues to be driven by North America and Europe, etc., etc., etc. So my biggest fear, actually, for 2025 is that a lot of companies stay a little bit on their hands because you don't know where you want to put your assets.
It's an excellent point. Fernando, will we see a growing global divide?
I think so. Unfortunately, again, I understand when Karen she talks about these post-globalization, but it's hard for me not to think in this global divide. We're seeing that in South America, for example, Argentina versus Brazil. We've seen that in Asia to some extent. We see that in Europe. So I think this is one real risk that we might face. And again, one thing that calls our attention in the report is that why is this happening? Because of geopolitical rivalries. That's true, it's shown on the report, but also because of local choices. And again, this should be respected. These are all democratic countries that are making these choices for populism. but I'm not sure they understand the extent of these choices of more protectionism on their daily lives, as Karen was brilliant putting here. They were concerned about 20% increase in prices, not because inflation is 2%. So this will not go back to the old days of the pre-pandemic. But I love the clubification story, but let me just mention two ones on the report. First, about fiscal policy trilemma. So countries will have to focus on aging, they'll have to focus on national security, and also on climate change. Fragmentation might affect this trilemma. And we had a new misery index. Misery index is a combination of inflation and unemployment. There might be another one touched on the report, maybe that includes immigration. So these things will be huge discussions moving forward.
Karen, I find that very interesting, you saying the US can't afford the IRA. Will the debt debate start now, or when do you see that happening?
Every side thinks, one side of the aisle always thinks the other side of the aisle spends too much until they get into power, and then it's very justified. The upside is that Doge actually finds some savings in government, but really, if you want to hear a serious discussion, so in Europe, the serious discussion is a common capital market. In the US, it's entitlement spend. Unless you are having a serious conversation about entitlement spend, you're not having a serious conversation about the fiscal situation, and I haven't heard that. Maybe I haven't been listening hard enough.
But the markets might start the discussion at some point.
They might, right? There's just the bonds, the term premium went up. Is that the bond vigilantes? And I don't know. The markets may start that discussion, but how much of that is just an expectation of longer growth? How much of that is the disinversion of the yield curve? I think it's too easy right now to over-index to very short-term issues until that some politician is willing to say, elect me or don't re-elect me, we have got to tackle what we're spending on Social Security and Medicare, then we're not having a serious discussion.
Yeah, but again, I think there are early signs on the yield curve. So again, we don't know if it's growth, I don't know if it's risk premium, but for example, we will use it to live in a world of low interest rates and high levels of indebtedness. Some people even came with, sorry for the word, crazy idea of modern monetary theory, talking about you can issue that unbounded. Wow, we are not living in this world anymore. Maybe the heydays of high indebtedness have come to an end, and you have to talk seriously about not the budgets themselves, but the debt dynamics, and that dynamics include entitlements, includes issues about fragmentation too. So, well, I think fiscal policy will charge its price on markets at some point in time.
We almost have to wrap up. I've one last point. So a very interesting number, and you mentioned that already. In 24, we've seen a new record in trade, global trade. It's $33 trillion. Will this be the highest number in a long time? Maybe all of you very quickly. Fernando?
Yeah, I think we are close to a topic there, so probably.
Karen?
Well, China certainly hopes not, right? I mean, their economy is dependent right now on external demand because of their domestic situation. So some of that will depend on, the global south cannot replace the US as a consumer, but certainly that would be a bad outcome for China to see that number shrink.
Gilles?
There's no contradiction between fragmentation and a continuation of the increase in global trade. It's just that you don't trade with the same people. As far as our economies continue to diversify and continues to grow on trend, I would still expect a growth in trade, just not along the same lines.
Let's come to our very quick final round. What would be the most important single piece of advice for policymakers and executives to get ready for 2025 when it comes to global economical risks? Fernando?
Well, maybe I start. Maybe I should say to policymakers, they should prove we economists are wrong. So how can they do that? Just by simply not supporting that much protectionism, by not support those huge increase in tariffs. But truth to be told, my most important concern is about fiscal policy these days. It's not a pending concern, it's not something for the very short term, but I think we'll talk a lot about that in the next few years or so.
Gilles, your recommendation?
Plow your own furrow for policymakers. I mean, the temptation is that we're going to be consumed by the bilateral negotiations with the US, and obviously everyone will need to engage with Washington, D.C., but don't forget to put your own house into order. If there's one message for me, it's really that. China, Europe, there's a lot we need to do domestically, and we can do it even if we get pressure coming from Washington, D.C.
Karen.
When you're thinking about the US, which, as we've, I think, agreed is the center right now of global growth, be careful not to engage in the parable of the elephant, that you assume there's that there's a single policy that's dominating. I think when we look at the Trump administration, we see, yes, balanced and fair trade, also national security and rediversification of the US manufacturing base. Can all of these things happen in 2025? No, none of them will be complete then, but the closer as a company you are to hitting all three of those, the more you need to be thoughtful about how you access that US market.
Fernando, Karen, Gilles, thank you very much for the discussion. Thank you all for coming and have a great day.